History books tell you the Black Death killed medieval Europe. Rats carried fleas. Fleas carried bacteria. The bacteria killed between 75 and 200 million people. This is true. It is also incomplete. The Black Death arrived in 1347, but medieval Europe had already been dying for 4 years. In 1343, two Florentine banking families collapsed, the Bardi and the Peruzzi. Their names mean nothing to you now. In the 14th century, they were the financial spine of Western civilization. When they fell, they took Europe's economy with them. The plague did not arrive in a healthy society. It arrived in a continent already starving, already weak, already broken by a financial catastrophe nobody remembers. You have heard of the Black Death. You have never heard of its accomplice. The Bardi and Peruzzi were not wealthy families. Wealth implies money sitting in vaults. These families were different. These families controlled the flow of money itself. They operated as gatekeepers to credit across England, France, Italy, and the Papal States. They maintained infrastructure for moving gold across borders before modern banking existed. They held leverage over kings who needed to finance wars. The distinction matters. A wealthy man loses his fortune and his family suffers. A gatekeeper collapses and the entire system behind him goes dark. The Bardi and Peruzzi sat at pressure points in medieval finance. Remove them and trade halted. Remove them and credit vanished. Remove them, and populations who had grown dependent on imported grain had no way to pay for food. The extraction of interest payments from royal debtors funded these families' operations. The concentration of sovereign debt on their books made them indispensable, until it made them vulnerable. When England's King Edward III refused to repay 1.5 million gold florins, he did not bankrupt two families. He triggered a machinery of collapse engineered into the structure of medieval finance. Welcome to the history of wealth. Behind every headline in your history book, there's a ledger they kept hidden. We open it. The story ended 7 centuries ago. Its lessons remain current. In 2008, Lehman Brothers collapsed and nearly pulled down the global financial system with it. Governments intervened with bailouts to prevent a cascade. They called institutions too big to fail. In medieval Florence, there were no bailouts. There was no lender of last resort. There was no central bank. There was only collapse. The Bardi and Peruzzi held debt from the King of England on their books. When he defaulted, they were unable to pay their depositors. When they failed to pay their depositors, other banks exposed to them failed. When those banks failed, trade financing dried up. When trade financing dried up, grain stopped moving. When grain stopped moving, people starved. This sequence took 4 years to reach its full expression. Then the plague arrived. The populations weakened by malnutrition died at higher rates. The medical infrastructure degraded by economic collapse failed to respond. The governments bankrupted by cascading bank failures were unable to coordinate quarantines or relief. The Black Death did not kill a healthy Europe. It killed a Europe already on its knees. And the man who pushed it there? Edward III of England, a king who borrowed money he had no intention of repaying. This is the story of the first sovereign debt crisis, the first banking collapse, the first too big to fail moment. It is also the story of what happens when there is no bailout. Florence in 1300 dominated European finance the way New York dominates it today. The city held no natural advantages. It controlled no major port. It possessed no gold mines or silver deposits. Its territory covered a small patch of northern Italy, surrounded by rivals. What Florence had was a system. The Florentine gold florin, first minted in 1252, became the reserve currency of medieval Europe. Standardized weight, standardized purity. Accepted from London to Constantinople, the florin allowed Florentine merchants to operate across borders in ways their competitors failed to match. This currency dominance created the conditions for something new: international banking. 3 family firms rose to control this new industry: the Bardi, the Peruzzi, and later the Acciaiuoli. Historians call them the super companies. The term captures their scale. At their peak, the Bardi employed over 300 agents across Europe. The Peruzzi maintained permanent offices in London, Paris, Bruges, Naples, Cyprus, and a dozen other cities. These were not banks in the modern sense. They were hybrid organizations blending trade, finance, insurance, and commodity dealing. A single transaction would involve multiple steps. First, purchasing wool in England, then shipping it to Flanders for processing, then financing the manufacturing through short-term credit, then transporting finished cloth to Italian markets, then collecting payment in local currencies, then converting profits back to florins, and finally, lending the proceeds to sovereigns or the papacy. Each step generated fees. Each step generated intelligence about market conditions. Each step built relationships with local powers. The Bardi and Peruzzi became indispensable because they performed functions no one else performed. You wanted to move money from London to Rome without physically transporting gold through bandit-infested territory. The super companies issued bills of exchange. You deposited money in London. You received a document. You presented the document in Rome. You collected your money. This seems simple now. In 1300, it was revolutionary. You wanted to finance a military campaign, but your tax revenues would not arrive for 6 months. The super companies provided bridge loans. They accepted future revenues as collateral. They charged interest, disguised as fees to avoid church prohibitions on usury. You wanted to collect papal tithes from parishes across England and transfer the funds to Avignon. The super companies handled it. They maintained the local presence, the collection networks, and the transfer mechanisms. The church became their second largest client. The papacy deposited enormous sums with the Bardi and Peruzzi. These deposits funded the company's lending operations. The arrangement worked for everyone. The Pope earned returns on idle funds. The bankers accessed cheap capital. But the largest client of all was the English crown. Edward III became King of England in 1327. He inherited a weakened throne. His father, Edward II, had been deposed and murdered. The treasury stood empty. The barons were restive. The new king needed to establish authority. And in medieval politics, authority came from military success. Edward looked to France. His mother was the daughter of the French king Philip IV. When the French royal line died out in 1328, Edward believed he had a valid claim to the French throne. The French nobility disagreed and crowned Philip VI instead. This dispute would become the 100 Years' War. Edward began preparing for invasion in the early 1330s. He needed ships. He needed soldiers. He needed alliances with German princes and Low Country lords who would pressure France from the east. He needed money, vast sums of money. England's tax revenues failed to cover the costs. Edward turned to the Florentine super companies. The Bardi had maintained a London office since 1290. They knew England. They had lent to earlier English kings. They understood the revenue streams available as collateral. The wool customs, the taxation of clergy, the crown lands. The Peruzzi joined them in financing Edward's ambitions. Between 1337 and 1340, the lending accelerated dramatically. Edward needed 200,000 florins to secure alliances with German princes. He needed 100,000 more to outfit his invasion fleet. He needed ongoing credit to pay soldiers and purchase supplies. The super companies provided it all. The loans carried attractive terms. Interest rates, disguised as fees and currency premiums, yielded 15 to 25% annual returns. The collateral appeared solid. English wool was Europe's most valuable raw material, and the bankers received monopoly rights to purchase and export it. The super companies also gained something beyond money: access. Financing the English crown brought royal favor. It brought contracts to manage royal revenues. It brought intelligence about English trade and politics before competitors learned of it. The Bardi and Peruzzi saw themselves as too important to abandon. They believed Edward needed them as much as they needed Edward. A king who wanted to continue fighting required continued credit. Default would cut him off from future financing. This calculation contained a fatal flaw. It assumed Edward cared about future credit. It assumed he intended to keep fighting indefinitely. It assumed he would remain dependent on Italian financiers. By 1340, none of these assumptions held. Edward's invasion of France had stalled. His German alliances had fractured. His English subjects resisted new taxes to fund what looked like a failing war. The king faced a choice. He would either repay his Italian bankers and end his military ambitions, or he would default on his debts and redirect those resources to stabilizing his domestic position. Edward chose default. Giovanni Villani recorded the collapse in his chronicle. He had personal stakes in the crisis. He lost money when the banks failed. He would die of the plague within years. His account provides the clearest contemporary numbers. The Bardi were owed 900,000 gold florins by Edward III. The Peruzzi were owed 600,000 florins. The combined debt of 1.5 million florins represented approximately 5 times England's annual royal revenue. Edward did not announce default dramatically. He stopped paying. In 1340, he ordered the arrest of the Bardi and Peruzzi agents in England. He accused them of usury and other financial crimes. He seized their assets in English territory. He made clear, through these actions, no repayment would follow. The super companies attempted to salvage what they were able to recover. They negotiated. They offered reduced settlements. They accepted partial payments stretched over decades. Edward gave them nothing. The first consequence arrived in Florence within months. The super companies were unable to meet their obligations. Remember the structure. The Bardi and Peruzzi accepted deposits from wealthy Florentines, from the papacy, from other merchants across Europe. They paid interest on these deposits. They funded the interest payments through the returns on their loans. When the English loans stopped generating returns, the deposit obligations continued. The super companies attempted to stall, and they delayed withdrawals. And they offered depositors partial payments. They sold assets to raise cash. It was not enough. In 1343, the Peruzzi declared bankruptcy. In 1346, the Bardi followed. The bankruptcies destroyed more than 2 family fortunes. They destroyed the accumulated capital of their depositors. Florentine tax records from this period tell the story. Property values collapsed. The catastrophe records show assessments dropping 40 to 60% between 1343 and 1348. Businesses shuttered. Families who had built wealth over generations found themselves insolvent overnight. The papacy lost substantial sums. The Vatican archives contain records of papal deposits with both firms. The Avignon popes, already struggling to maintain church operations during the Babylonian captivity, now faced additional financial strain. But the crisis did not stop in Florence. The super companies were not isolated institutions. They formed nodes in a network. Other banks had lent to them. Other merchants held claims on them. Other cities depended on the credit and trade financing they provided. When the Bardi and Peruzzi fell, they pulled these connected institutions down with them. Smaller Florentine banks failed in 1343 and 1344. Banks in Siena, Lucca, and Venice faced runs as depositors rushed to withdraw funds before their institutions collapsed too. Some survived. Many did not. The credit contraction radiated outward. Merchants who relied on Florentine letters of credit to finance trade found their instruments worthless. Goods sat in warehouses because buyers were unable to secure financing. Ships remained in port because traders were unable to insure cargoes or pay crews. The medieval economy depended on credit in ways modern observers often fail to appreciate. Peasants did not live in a cash economy. Seasonal agricultural cycles created constant timing mismatches between expenses and revenues. Credit bridged these gaps. When credit disappeared, the real economy contracted. The financial crisis of 1343 to 1346 coincided with and amplified agricultural disruptions already underway. The medieval warm period had ended. Temperatures dropped across Europe beginning in the early 1300s. Growing seasons shortened. Harvests became less predictable. The Great Famine of 1315 to 1317 had already demonstrated the vulnerability of medieval agriculture to climate shifts. Millions died across northern Europe. Population growth, robust for 2 centuries, stalled. The post-1343 credit collapse worsened these pressures. Medieval grain markets depended on merchant intermediaries. Farmers in surplus regions sold to traders. Traders transported grain to deficit regions. This required financing at every step, advances to farmers, payment for transport, warehousing costs. When Florentine banks failed, this financing disappeared. Grain continued to grow in fields, but the commercial machinery moving it to where populations needed it broke down. Regional famines struck areas previously supplied by long-distance trade. Prices spiked in deficit regions, while surplus regions saw crops rot because no buyer had credit to purchase them. The crisis struck hardest at the margins. Urban populations dependent on food imports suffered most. The rural poor, who survived through a combination of their own production and seasonal wage labor, found wages falling as economic activity contracted. Malnutrition spread. Malnutrition does not kill directly. It weakens immune systems. It leaves populations vulnerable to diseases the body would normally fight off. It transforms survivable infections into fatal ones. By 1346, 4 years of economic crisis had degraded the health of European populations. Not everywhere, not uniformly, but significantly. The crisis also degraded institutional capacity. Municipal governments derived revenues from trade taxes and property assessments. When trade collapsed and property values fell, revenues fell with them. Cities cut spending. They reduced guards. They deferred maintenance on walls and public works. They had less capacity to respond to emergencies. The church, still reeling from papal deposit losses, reduced charitable operations. Monasteries providing food to the poor found their own resources strained. Hospitals dependent on church funding operated at diminished capacity. The medical infrastructure, such as it was, contracted. Medieval medicine offered little against plague. The miasma theory dominated thinking about disease. Physicians had no concept of bacteria or contagion in the modern sense. But medieval cities did have quarantine practices, developed from experience with earlier epidemics. They had systems for isolating the sick. They had capacity to organize public health responses. These systems required money to implement. They required functioning governments to coordinate. They required social trust to enforce. The banking crisis had damaged all three. This was the Europe the plague would find. Not a thriving civilization brought low by an external shock, but a wounded civilization, weakened by 4 years of financial collapse and its cascading consequences, facing a pathogen it was unable to understand and barely organized to resist. The Black Death reached Sicily in October 1347. Genoese trading ships carried it from the Crimea, where Mongol armies had catapulted infected corpses over city walls during a siege. From Sicily, the plague spread north and reached Florence in early 1348. Giovanni Villani, the chronicler who had documented the banking collapse, was among its victims. His chronicle ends mid-sentence because the plague killed him before he finished. The mortality was staggering. Modern estimates suggest 30 to 60% of Europe's population died between 1347 and 1351. Some regions lost 3/4 of their inhabitants. The deaths were not random. Cities died faster than the countryside because dense populations allowed rapid transmission. The urban poor, crowded into unsanitary quarters, died at higher rates than the wealthy. Within these patterns, the economic crisis of 1343 to 1346 left its mark. Regions hardest hit by the credit collapse and famines showed higher plague mortality. Malnourished populations died faster, and communities with weakened institutions were unable to organize quarantines or care for the sick. The plague did not cause the banking crisis, and the banking crisis did not cause the plague, but together they produced a civilizational rupture. The medieval world before 1347 and after 1351 became very different. Population levels took 150 years to recover. Labor shortages pushed wages higher and weakened the feudal system. The church lost authority as people saw clergy die like everyone else. Florence also changed its banking model. New banks, such as the Medici, avoided concentrating their loans in a single sovereign debtor like the Bardi and Peruzzi had done. The lesson lasted a few generations before being forgotten. The modern banking system still operates on the same structure. Banks take deposits, lend them out, and profit from the difference. This creates the same vulnerability. If borrowers default or depositors panic, banks can fail and credit to the real economy disappears. Modern governments try to manage this risk through central banks, deposit insurance, and financial regulation. These systems mostly work, but they do not eliminate the risk. The 2008 financial crisis showed how concentrated risk can still threaten the system. Lehman Brothers collapsed and governments intervened with massive bailouts to prevent a chain reaction. More recently, Silicon Valley Bank collapsed in 2023, when rising interest rates reduced the value of its government bond holdings and depositors rushed to withdraw funds. The government intervened again to stabilize the system. The pattern repeats because the structure remains. Banks are tempted to concentrate risk during good times for higher returns, while governments must choose between allowing collapse or providing bailouts. The medieval bankers believed English royal debt was safe. They were wrong. Modern banks often believe government bonds are safe. Usually they are. But crises such as the European debt crisis showed that even sovereign debt can become dangerous when systems are stressed. Your savings account, pension funds, and job all exist inside this structure. You are protected not by perfect safety, but by institutions designed to manage these risks. The real danger appears when multiple crises combine. A financial crisis during a pandemic, a debt collapse during a climate disaster, or a banking crisis during social instability can overwhelm even strong institutions. In the 14th century, the banking collapse weakened Europe, and the Black Death arrived when the continent was already vulnerable. Together, they created a disaster far greater than either alone. The same structural vulnerabilities still exist today. The institutions are stronger, but the risks remain. History does not repeat exactly, but its patterns often rhyme. The medieval bankers concentrated their risk in a single powerful borrower. Modern financial systems still face the same choice, and the consequences of choosing wrong remain the same.